You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi, this is Tom Cock. Welcome to Talking Real Money. Now, my heart truly goes out to many of you. Many of you have been great savers. You scrimped, you set money aside for the future, and now the future's here, and you don't want to take a lot of risk with your money, but you want to make something on it. And you're calling me. You're saying, I had all of this money in CDs that were paying me 2.5%, that I used that income to add to my retirement and made things pretty decent. And now my bank is telling me if I want to renew that CD, that matured CD, that they're going to give me 0.7% or something like that for an extended period of time. And yeah, it kind of does break my heart, because what do you do? What do you do with this safe money in this extremely low interest environment that we find ourselves in, that I think we're going to find ourselves in for some time, because the Federal Reserve has decided to keep rates very, very low for an extended period of time. So before we talk about what you should do, let's talk about some of the things you shouldn't do, because I read with great interest in our local paper in Seattle, the Seattle Times, with a lengthy article that apparently came from Bloomberg talking about all of the defaults in corporate bonds, the corporate bond world. Now, of course, you're aware that businesses, many have had a very difficult time the last 7 months, as the COVID shutdown has changed dramatically the landscape, certainly of retail and other businesses, right? Bankruptcy filings are surging. But here's the part that you may not have heard of, because most people think even in a bankruptcy, the bondholders get something. And traditionally 30-40%, but it's way less, because many of those people, those corporations, have not just sold bonds, but then they tried to go and refinance. They added another debt. It's very complicated. But for example, here's a couple of examples. The owner of the Men's Warehouse, the debt issued by Men's Warehouse, that is trading at 2 cents on the dollar. Neiman Marcus, very high-end retailer, 3 cents on a dollar. That doesn't sound like any sort of fixed income you want to own. And of course, we've always told you that you really don't want to own individual bonds anyway, unless you really have a lot of money and there's reasons to own individual bonds for taxation. But of course, you could always use municipal bonds, I think, for that. But as the pandemic has upended industries like retail and energy, these defaults are rising. The defaults are going to be very expensive to people, and more investors, holders of those loans and secured bonds, they're going to be out fighting for those same scraps when the companies do file for bankruptcy. And for people that still say, look, I got to make something on my fixed income, I always point, because I trust Vanguard, the Vanguard High Yield Corporate Bond Fund. Now, again, we do not use this for our clients. I do not recommend this. And remember, more people have lost money reaching for yield than at the end of a gun. That's an old Wall Street expression. The Vanguard High Yield Corporate Bond Fund, VWEHZ, only charges 23 basis points. The yield, wow, is an astounding 4.9%. That's all the good news there is to report, because listen to this. Its credit rating is BB, 95%. 95% of the holdings are BB or lower. Things like Caesars. Wow, I don't know how Caesars is going to come out of all this, but I doubt the news is going to be good. So let's go back to my CDs just matured. What am I going to do? Number one, if the CDs, and it sounds like they were part of your safe money, then that money should go into safe bonds, short and intermediate term government bonds. That's a corporation I think will always pay you back. They always have. Yeah, the interest rates are very, very low, but you're going to get your money back. Number 2, do not go out and reach for yield. Don't look at an offer that says I can make it easy 4%. Doesn't exist. You're just taking a lot more risk than you realized. Number 3, and this is part of the equation that I have talked to a number of people about. I think one of the messages the Federal Reserve has sent us is you need to invest in stocks or something like stocks to make money. Because we're holding interest rates so low, that money should go there. And that's, I think, had something to do with the rise in stock prices over the last couple of years, but that's a whole separate podcast. So if your safe money needs to go into something to make money, you should be adding that money into your overall portfolio holdings. In other words, if you have a stock to bond ratio of 60-40, that safe money should come out, some of it into bonds, some of it into stocks. Whatever your ratio is, that should hold. You shouldn't be taking on new risk. You shouldn't be rushing money into stocks if that's not part of your overall holdings. This is not a time, as we say, reaching for yield to get a little pregnant. Stay the course, have an asset allocation for the future. I think you'll be much better off in the long term. And again, if you want a review of your portfolio, if you want to talk to a professional, we give you 1 hour absolutely free. You can contact us form at talkingrealmoney.com. We are glad to help, especially during these difficult times. Thanks for joining me. I'm Tom Cock.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Should keep the lawyers happy.